Good morning, everyone, and welcome to the Mortgage Administrator online event. My name is Anna, Deputy Editor for Mortgage Solutions. We have a jam-packed day today with sessions covering everything from the mortgage market outlook, protection, technology, compliance, and the importance of the mortgage administrator community. The first session of the day we'll look at what the future holds for the UK mortgage market this year and beyond, hosted by Sidney Wager, Managing Director of L&C Mortgages. It will look at what's on the horizon for the mortgage market under the Labour government, FCA and protection reform, as well as opportunities and growth areas in the next year or so. I'm really looking forward to this session, and if you have any questions, please do submit them and we will do our best to answer them. So without further ado, I'll hand over to Sidney to kick off the Mortgage Administrator online event.
Morning all, and I'm really pleased to be here today with you this morning. And as Anna said, I'm Sidney Wager, Managing Director of L&C Mortgages. So I am going to just spend the next, I think I've got about 2 hours. I am joking. I've got about 20-25 minutes to talk about this. But what I really want to do is encourage conversation from you guys. So please do put your questions in. For those that know me, I am not scared of talking. So I really want to hear what's important to you. So I am going to kick off with just a few slides, and I'm going to keep them quite high level and very deliberately so. So I think the first thing to talk about, and I just want to cover this really quickly, is I think everybody talks about interest rates and what's the size of the market, etc. And I think it's just really important to set some context. So this continues to be an absolutely important sector for the UK economy. And as you can see from the gross lending figures, it's a huge market and a huge contributor to GDP. I think what's really interesting is that as an intermediated market, we in essence contribute anything from between 85 to 90% of that total gross, which I think is just goes to show you how important what we do is. And I think when you look at interest rates, which always continues to be the thing that seems to garner the most interest, you can see the challenge that we've seen in interest rates previously and what the projections are looking likely to be. You can see that there is clearly an expectation that interest rates will drop, and we've seen the government and the MPC really look at interest rates and start to drop base rates, and we expect that to continue through the course of the year. Please don't ask me how many drops I expect to see, because I think if you put any economist in a room or any lender in a room, they'll come up with 101 different versions of the truth. But I think what's interesting is that we're continuing to see 25 basis points drops, and we're probably looking at another, I would suggest, at least 2, possibly 3 more during the course of the year. But I would always caveat that with the thing that I think has made this sector more exciting than ever, which is the fact that what we call geopolitical impact is seemingly having more impact on our sector than anything else. And to sum that up, that's kind of saying factors that are external to the UK economy and environment that could potentially impact interest rates, gilt rates, swap rates. Now, swap rates, and I don't want to teach anybody how to suck eggs, but I think what you're seeing here is base rate. But actually, the thing that determines us for that this is base rate is fine for anything that is kind of tracker linked, so it's linked to base rate. But of course, the thing that is most important for lenders, especially because that's how they price their money, is swap rates. And the geopolitical, and by that I mean it could be anything from challenges transatlantically, changing oil prices, gold, etc. Anything like that can impact swap rates, and those swap rates determine the cost of borrowing for lenders, which invariably means that if they have borrowed money at particular rates and swap rates change adversely, they need to move quickly. Hence, you see things that probably impact you, especially like rate pools. So whilst this is important, I think it's really important to understand more so than ever before, our market is being impacted by factors beyond just the UK. But when we think about the government and we think about what specific policies will affect the mortgage and protection market, I think it's clear to say that the current incumbent government is really clear that housing, and we saw the size of the market, is absolutely central to their strategy, and it's seen and what's seen as a stretch target to really address the lack of supply. We've known historically for a number of years there has been a lack of supply, especially around affordable housing. So the right conversations are being had in the hallowed halls of the House of Commons around how we as a sector, and that's all elements of that ecosystem. So that's house builders, it's intermediated brokers like ourselves and lenders, to work out exactly what we need to do to address that. So whilst there has been skepticism about approaching the supply challenges, there's absolutely some positivity in the ambition to address the structural issues, which should ultimately ensure that we're able to deliver more affordable housing, because as we know, affordable housing is going to continue to be a key and core challenge going forward. If you only have to look at some of the regional disparities around first-time buyer ages to really understand how much of a challenge that is. So whilst there's currently a relatively slow return of confidence, which has been dented by cost of living crisis and rapid rises historically in interest rates, I think we're beginning to see rates ease back down, which should result in more and sustained growth, especially in the purchase market. And we really need the purchase market to reignite itself in a way that we've seen to sort of previous historical levels. And I think that's going to come. But I think it's not going to come as quickly as we all want, because actually the government needs to be uber conscious. We've seen the latest inflation figures, which are tending to be relatively erratic, albeit more positive, which of course has a knock-on effect on what the Bank of England and the MPC committee are doing with interest rates. We also know that there's a significant amount of maturities this year, which will result in a really strong remortgage and product transfer market, and that's likely to persist. I think you need to buckle yourselves in, because there is no doubt that there will be a lot of work. There are a lot of maturities in that space. And I think the thing to remember more so than ever before, which is constantly becoming a challenge for us, is that our customers are becoming increasingly more financially literate, which means the expectation on us as brokers, on lenders to provide innovation around products, as well as us providing the right level of advice, continues. And I think the thing I probably should have mentioned is, whilst the market is traveling around the 85–90%, what that absolutely means is this now more than ever before is a time that clients need advice. They need our advice. They need us. They need you. And you are so critical to making sure that absolutely continues to move smoothly. I think it's fair to say that the work of the FCA is going to be critical, and there are a number of reviews going on at the moment, and I'm going to talk a little bit about those in a minute. So I think when you really think about what's going on in that maturity space, there's no doubt that whilst there will be a strong PT market, I also believe that whilst the buy-to-let market is likely to be relatively muted, there will continue to be a shift towards more professional offerings in that space around limited company buy-to-lets. And I know that a number of lenders, I think Coventry were one of the latest to move into the limited company space, and more lenders are likely to join. So I think the market is alive and kicking. Probably it's not as fast paced as it has been historically, but I think that's all due to come. So the government's already begun to apply some pressure in laying down a challenge for the regulator to remove red tape and make it easier for aspiring movers and first-time buyers to actually move and get on the ladder. We've already seen that there's been clarification around the approach to stress rates, which has helped boost affordability. And anybody that's interested, and I'm sure you all are, the FCA delivered a paper yesterday, which I think is about 75 odd pages, which I'm yet to go through myself, so I know tricky questions on it. But it really does center around some of the core things that are going to be important for us and for borrowers in that space. So it really does center around things like I said, stress rates and affordability, later life lending, treatment of vulnerable customers, and interest only and shared ownership, all of which are really extremely topical subjects at the moment. So I think it's going to be really interesting, because there is no doubt that innovation is going to play a real key. And I'm going to talk a little bit about that probably in the next, on my next slide. So lenders already try to offer more flexibility on lending multiples where they can, although of course you need to be mindful of things like LTI flow limits, which being something that really helps to manage how much lenders are able to lend in this space. Now, for those of you that don't know, I've been with a lender for a number of years, so I think I'm in a relatively privileged position where I understand both elements of how this equilibrium works. So I think that lenders, no doubt, will be looking to innovate, because as we continue to go through what's been a really challenging old period. Look, we've come through COVID, we've come through difficult economic times, we've come through government changes around budgets and the way in which the market is treated, we've come through MMR. So it's been a tough old roller coaster. But I think the thing that I love, and the reason I love this market, and I hope you do, is that it's resilient and it's adaptable. And what we'll continue to do is evolve. So like I said, I think lenders have been looking at their multiples, and they have been looking at how you make it more, you can make it more affordable. But I think we're going to continue to see innovation in this space as we continue to traverse through this year and into the next few. So the regulator has opened a door to make it easier for lenders to deal with execution only potentially, and of course there's a lot of talk around how this is likely to play out. Now, I think again, whilst this is clearly seen in a number of different ways by different people, I think this is all an attempt to make sure that we are doing the right things by our customers, but we clearly want to make sure that we're using the right tools to make that happen. But I think what continues to be true, and I said this a few minutes ago, is the fact that customers will continue to need us and will continue to need advice. So stress rates and advice were key areas of our MMR, and these were put into place to ensure that borrowers had headroom to afford any hikes in interest rates. The need for advice to prevent brokers being mistakenly put into a disadvantageous position, I think, still remains true. So the regulator's review of the protection market will be, of course, interesting. Hence, you can see some of the protection advisors on my slide. Commission structures will come under scrutiny. And whilst we'll need to be careful to ensure that the market works to encourage as many as possible to take protection, and paying a fee could make it all the harder, there could be pressure for loading, there could be pressure on the way in which premiums are calculated, etc. But transparency continues to be key in this space. We will continue to always do the right thing by our customers, and I think the review will continue to ensure that we do this, and I'm looking forward to the outputs of that. So what does the future look like? Having said that, I am going to push my slide forward. So having said that, it's difficult to predict, I think it's also really interesting to start thinking about what opportunities and growth areas will continue to exist over the next kind of 12 to 18 months. This is where I think it gets really interesting. Of course, we need the regulator to continue to oversee what we do, to make sure that customers are treated in absolutely the right way. This is a regulated business, and let's be really clear, buying a home is still one of the most expensive personal outlays anybody would make. So we want to make sure that that's done in the right way. Borrowers will want advice. I cannot say that anymore. They will want advice. They need us. So whether that's to buy their first home or to remortgage their home or for an investment property, they need us. They need you. There is great choice for borrowers, but adds a layer of complexity, so that advice becomes really important to completion. So I think there are a number of things that you can see on the slide here that are really going to start to play into how those decisions are made by borrowers. I think there's absolutely no doubt that technology, which is a bit of a buzzword at the moment, and especially AI, whether that be generative or otherwise, is likely to be key. And the reason I say that is because there is no doubt that this is a market and an industry that, in my view, probably the barriers to entry have historically made it difficult for new entrants to really come in. I think AI the use of AI. And I think what we need to remember is AI isn't going to be done by any means, shape, or form as a replacement of us as humans. AI and data technology and being data led are all about the ways in which you use it to enable in order that we can do the jobs we need to do, because advice will continue to be needed. But I've got no doubt that if we don't embrace AI, we will be left behind. We will be laggard, because every other industry, every other sector will embrace it. So that doesn't just mean about front-end submission and data collection. For me, it's a whole ecosystem. That's from submission of application all the way through to completion and everything that sits in between. So I've got no doubt that data and technology will be key. There will be elements of AI that I think we'll see injected along the way, and we've seen that already. But I think it will increasingly be the better use of data in order that it acts as an enabler that makes our job easier. At the end of the day, my view, and probably a very personal view, AI for me really is about doing the laborious, repetitive tasks that humans will often get wrong. But actually, if you do that, do it well 100% of the time, as opposed to the way in which we do it as humans, you're likely to free up time capacity for us to do the things that we are best at, which will be providing advice and being that go-to person whenever our clients are looking for their next move or whatever it may be. I think what's going to be interesting as well, which I think will continue to provide opportunity, will be the way in which customers, you heard me talk a lot about clients needing us for advice, and the fact that they are more financially literate, they're also more requiring, right? They're also going to be very selective about who they choose to work with. If we don't share the value set of our consumers, we will find ourselves in a really difficult and challenging position where we could be absolutely deselected without even knowing that it's happened. So clients are going to be expecting to see us operating with a really clear green agenda, a really strong DE&I agenda, and absolutely things like being B Corp, which is all about the way in which your business is integrated into its wider ecosystem, and the way in which it treats many of the elements across those agendas will become critical. So if you kind of put all of that together, you mash it all up, what that fundamentally says is there will be opportunity for those that are willing to embrace this. Of course, there's going to be a need for innovation. Of course, there's going to be a need for more holistic advice, because if you also think about it, when you think, the way I think about opportunity isn't to think about what can we do differently, but more about what can we do in step with the way in which our consumers and customers are going to want to either consume and buy a mortgage or interact with a mortgage broker or a lender. You need to be thinking about what are the things you need to do that your customers want or your customers of the future will want, which is why I talk a lot about the fact that if we get this misstep wrong, our customers will choose to the new customers. And when I say new customers, I'm talking about the next generation, the generation of my kids. I've got two daughters who I can absolutely assure you will deselect any provider, whether that's a mortgage provider or otherwise, if they don't share the same value set. So what do I see as the opportunity? The opportunity absolutely sits in making sure you're in step with your clients and you get this right. There have to be more innovation. I think we need to be looking at ways in which, for example, and this is an example, as an industry, we know that we're in a really unique position where there's almost a new segment of people that have a young generation of kids that are growing and an elder generation of parents that they're now caring for. So actually, from an advice perspective, you need to be thinking about those needs have now changed at both ends, and those needs for that individual has changed. So how does our advice change in order that we start to tailor our thinking and tailor our advice proposition? Buy to let, like I said, will be an opportunity. I think the things that the FCA are already talking about and looking at, especially the way in which you get first-time buyers onto the ladder, and the ways in which we've got other schemes potentially around different ways in which you make it easier to either get onto the ladder or continue to acquire assets. So actually, I love it, because I think despite what has been a pretty turbulent time, let's be honest, over the last few years, I'm really buzzed up about what the next few years will look like, and embracing all of this to make sure that you get it right. So look, as I said, I'm just looking at the time, and I think we have 10 minutes or so left. So I would really love to stop and take questions, because I've talked pretty fast and tried to squeeze a lot in. So hopefully we've got some questions on the go there, Anna.
Yes, thanks so much, Sidney, for that really kind of whistle-stop tour of everything that's going on in the mortgage market. I mean, it is very, there's a lot of different, there's a lot of different currents going on at the moment. One question that's come through, which is about interest rates, which I kind of feel like you definitely talked about in the presentation, is like, would you say, so one of the questions is it fair to say that the trend will be lower interest rates in the next 2 years? I don't know. You said don't put you on the spot. I'm going to put you on the spot.
No, but absolutely, Anna, I fully expect to be put on the spot. Listen, as long as nobody's going to go out saying Sidney Wager of L&C quoted that I absolutely believe we're going to see X, Y, and Z. Look, I do believe we'll see drops in interest rate, because I think we'll need it to stimulate the market to a certain extent. But equally, I think the thing about interest rates as well, and I'm talking more about base rates, I talk a lot about consumers. And actually, what consumers understand in here is interest rates. Interest rates are high, interest rates are low. Let's be really clear. There are people that will be coming off sub 2% rates and going on to something that's going to start with a 4. There will be some interest rate shocks. So that's why interest rates become so prevalent and so clear in the mind. But I do believe we will see drops. How many we'll see, I think, will be totally dependent on factors like where inflation goes, and as I said, the geopolitical impact of things that could happen outside of the UK economy. But I think there is no doubt that if I were to put my 11 economists in a room, who would no doubt come up with 14 different versions of the truth, I think we would see the trajectory would definitely be downwards. How quickly and how often and the frequency, I think, is up for debates.
And you did talk about the government's really put housing at the center of its mission. And one of the things that they said that they would do was make the mortgage guarantee scheme permanent. And I think they said they'd do that in July. Do you think that's do you think that will be a positive for the market? I mean, it's still June, but we haven't heard anything as of yet. But
so cool. It'd be crazy for me to come up with a definitive on that. But I think the reality for me and it's not even just the mortgage guarantee scheme, it's schemes in general. I think we need to make sure that whatever we do has the desired outcome and the right outcome from a customer perspective, but make sure that it ticks all boxes. Because I think if you think about some of the previous schemes, there are lots of people that will say they were fantastic, and others that will say, actually, for example, did it get people into properties that they potentially should have waited a few more years to get onto, etc. So I think my view with schemes, and it will always be, I really would rather we did the correct due diligence that made sure we had the right and intended outcome, to ensure any unintended, we do everything we possibly can to mitigate any unintended consequence.
Yeah, I mean, thinking about like Help to Buy, for example, that kind of had some unintended consequences. It was great and suited a lot of people, but it did have, led to more kind of house price inflation, and people you said, maybe going for properties that, was maybe a step ahead of where they should have got to. I've got another question here about about the role of administrators, and for instance, like technology and AI can, like you said, really help with that. Is helping deal with those repetitive tasks. So do you think the role of the administrator will have to become more strategic and have to do you see their responsibilities evolving in the future mortgage market?
Really interesting question. I was expecting a slightly different one, but listen, I believe that if you are in, I'm not talking about just administrators, I'm talking about life and I guess personalities. I think you should always be looking to evolve anyway. And what we should be looking to do is, because the world, the communities, and the people we serve externally will continue to evolve. So it doesn't make sense for us not to. So I think that it's absolutely normal that you do evolve. And I think AI, I don't know that you necessarily mean strategic. I'm always a bit cautious of that word because I think it means different things to different people. But I think this is about embracing what technology and AI may bring and how that enhances your ability to do the role even better than we do today, because that will be the requirement of our customers. Therefore, it makes sense that we continue to evolve to do that. I don't see AI or tech replacing people, because I think what you do is you repurpose skill set, you grow, you evolve, and you work out how to use it as an enabler to become even better in the role that you do today.
Yeah, I think we've got another couple of questions kind of coming through, talking, because there is maybe some concern that AI and automation might threaten that mortgage administrator role. But from what you're saying is that actually it's going to maybe change the role, or actually it will just mean that your role will evolve. Would you say that's fair?
I absolutely believe it's an evolution of the role, not a change of the role. I think it's really interesting that there's always a default position that says, oh my God, technology and data will rule the world. Not everybody would choose to engage. So again, we got to be careful. Everybody is different. Clients choose to interact in a different way. Not everybody wants to use a single channel to do exactly the same thing. So you can't broad brush say tech is going to take over because everybody wants to talk to a bot and everybody wants to engage with the AI. Some will, some won't. Some will want to go part of the way, others, and it will be different. So I think there is no doubt tech and AI will play a role. What it does and how it does, I think, remains to be seen, because a day barely goes by without somebody approaching me saying, Sidney, we have the answer. We have the solution. It is over here. It looks like this. So everybody's thinking and doing that. What you're needing to do is to work out how, when, and what absolutely works for you. Now, just remember that we are the same as the people that we're choosing to work with. Our clients are our customers. We're exactly the same. So we're all on this journey of discovery together. So I just think we need to be really mindful that technology isn't in the first instance about, oh, we're going to broad brush replace everybody and everything will be done on the click of a screen, because there is a reason we've existed for as long as we have. But what will happen is the roles will have to evolve, because they do. That's human nature. That's life. That's what happens. So I don't think we should be scared by it. I think we should be embracing of it and understand how it works and fits for you. And always remember, I say to people all the time, you are your own PLC. So by that, I mean, you're in control of making decisions for yourself. So think about how you upskill yourself. Think about how you future-proof yourself to make your career sustainable. So what are the potential threats? But how do you think about yourself as you would any business and any business case? What's your SWOT? What are your strengths, weaknesses, opportunities, and threats? And what things do you need to do to continue to evolve? We'll need you. We might need you to operate slightly differently, but we will need you.
Yeah, I think that's really important, because there is that fear, but actually focusing on upskilling and actually on training, or kind of seeing where where you can possibly be more of a where the future is going, and that's also really important. You mentioned in the presentation lender innovation, and that's a very broad umbrella. I mean, are there any specific things that anything more specific that you're thinking where lenders, now that you're on the broker side of the fence, that anything that you would want to see more from lenders, things maybe like I'm thinking like Skipton's track record doing like including rental history, or kind of to put 100% LTV mortgages. What kind of stuff, innovation, would you like to see?
Look, I think again, innovation is broad brush, and I probably deliberately use it because innovation can take various guises, right? So you can innovate around criteria, you can innovate around LTIs, you can innovate, like you've just said, 100% mortgages, or you can innovate around what you use as collateral. I talked about the fact that, well, I probably didn't say this explicitly, but we know that we've got generations of people that are equity rich and cash poor. So, for example, how do you start to look at how you could untap some of that equity to assist others within your family, friends, whatever, getting on the ladder? So there are lots of things we can think about and lots of ways in which we can do it. I think what we all need to think about as an ecosystem is, what is it that's going to, what do we now see that's different, and what do our clients need, and how do we bridge that gap? Coming from a lender, I can tell you that trying to do, equity, using equity release, for example, or releasing equity as part of the deposit for, I don't know, members of your family, whether that's direct members or whatever, you start getting into the realms of cross collateralization of property, which is a difficult. Some of this stuff is so complex. So the reality for me is, how do you strip away some of that complexity and find easier ways? The rental income example is a good one, right?
Yeah.
So we know that it's taking, that there are some regions that the average age of a first-time buyer is nearing 38, 39, sometimes 40. So actually, you probably need to think about how you get people onto the ladder and make that slightly different, because in reality, a 40-year-old of today is very different to a first-time buyer of 2 decades ago in terms of the responsibility, etc., that they've had. So I think we're already seeing it. I'd hate to say do this or do that, because having sat the other side of the fence, it's not easy. But I think the reality is, we know that it's happening, and we're beginning to see examples come through.
Yeah, I think that's a really positive note to end on, Sidney. And thank you so much for taking the time today. And thank you to everyone who's attended. And I look forward to seeing you in the next sessions, which I think the next one's going to start at 10. So please, come back, and we're really looking forward to kicking off the rest of the day. So thank you so much.
Cheers all. Thank you.
Thank you.